I think oftentimes we talk a lot on the TV show about, the number one financial concern that a lot of retirees have, but I think we don't talk enough about what is the number one threat that's facing the average retiree. So Matt, could you talk a little bit about that?
Yeah, I think probably, Jordan, when individuals think what's the number one threat, I think probably a lot of times what they'll first come to mind are going to be things like maybe living too long, outliving their money. That's obviously a threat to individuals' retirements. A lot of times when you talk with individuals, they might mention their health or health insurance costs, long-term care costs, things like that. But I think if you look at it, we can plan for a lot of those different things, right? But one of the more difficult things to plan for, especially if they have the majority of their retirement nest egg tied up in just traditional tax-deferred strategies like IRAs, 401ks, 403bs, things like that, I think probably the number one threat that's a little more difficult for some people to plan for is going to be increasing taxes in the future. And although nobody has a crystal ball, I think that we can talk a little bit about changing demographics and baby boomers aging and moving into retirement. If you look at some of our entitlement programs that we have as a country, like Social Security, Medicare, and Medicaid, you can make a pretty strong argument that we'll probably have higher tax rates in the future than what we have currently. And I think that's probably going to be the number one threat for most individuals.
So what do we do then to protect ourselves from that threat? I know we talk a lot about tax-deferred accounts, tax-free strategies, taxable accounts. So is there some sort of a good idea that we can come up with, Dustin, on what we can do to help individuals put more money into tax-free strategies so they don't have to lose?
Yeah, you need to be working with someone that's proactively planning and it realizes these things, because like Matt said, taxes are something that's going to be unpredictable. It's not something you could plan for. Yeah. So in order to avoid that, you need to start trying to create some other buckets of money that are tax-free, to where even if taxes did go up, it's not really going to affect you.
I think what we're really talking about here is there's a saying that I use sometimes, and I know a lot of accountants and CPAs don't really like it, but I think a lot of people go into their idea of retirement planning with this misconception or this myth that they're going to retire and be in a much lower tax bracket than when they're working.
Yeah.
And I've been helping individuals for over 20 years now, and we have very, very few clients that actually retire in a lower bracket than when they were working. And there's really a couple of reasons for that. I think number one, if you think about it, you want to maintain your standard of living or your lifestyle once you retire, right? And so that's probably going to require about the same amount of money as when you were working. Now, what you're spending money on changes a little bit, because you're maybe not having to commute to an office every day, or someone like ourselves, when we retire, might not have to spend so much money on suits and sport coats, things like that, dresses, if you're in a professional workplace. But the spending shifts, right? So if you're retired, you're not spending 40 or 50 or 60 hours a week at an office or a company. So you got to fill that time doing something.
Every day Saturday.
Yeah,
that's right.
So your hobbies, maybe you do more traveling, things like that. And so a lot of times it ends up costing the same amount of money. I think the other issue that we see is the fact that once you go into retirement, you no longer have all the deductions that you had typically when you were working.
That's something that most people don't realize.
They don't realize it. So if you think about it, when you're working, what are some typical deductions that you have for your taxes? Well, a lot of times individuals will have a mortgage, so they're deducting that interest. Well, usually once you go into retirement, the house is paid for.
Hopefully. Yeah.
And if not, usually, if you're maybe the last few years of the mortgage, almost every payment you're making is just going towards principal, very little interest. The kids are grown and gone.
Yeah.
Hopefully.
Yeah,
right? So you don't have that deduction. You're not contributing to a 401k. So you're not getting a deduction for that. And then the other issue is charitable contributions. A lot of our clients, while they're working, they might write a check each year or each month, something like that, to churches or charities. But when they retire, maybe they want to cut back their expenses a little bit, or again, they've got all this extra time. So rather than just writing a check to the charity, they'll go volunteer their time at the charity, which is admirable, but the IRS doesn't allow you to deduct your time.
Right.
So what ends up happening is, more often than not, all of the deductions that you had while you were working are gone. And if you have the majority of your money in just a normal qualified retirement account, if tax rates go up in the future, and you can make a pretty strong argument that might happen, you're kind of stuck. Everything that you're taking from those retirement accounts are coming back to you just 100% taxable. Like Dustin was mentioning, what you really need to try and do to solve the problem or try and fix the problem is to make sure that you've got a significant sum of money in tax-free investments. It'll create more options and give you more flexibility. So obviously, Roth IRAs, certain types of insurance instruments might be growing tax-free, but you need to make sure that the majority of your retirement nest egg is not stuck in things like IRAs, 401ks.
And on that, some, tax rates right now, I don't know, the highest bracket, 40.
We're a little below 40% right now.
So
Yeah.
historically, that's still a pretty low number, right?
It is. It's pretty low. If you look at the history of income taxes, since we started paying income taxes in the country back in 1913, where we are today is arguably about as low as we've seen. And it's funny because anytime that you talk to individuals about what are they paying in taxes,
Too much.
everybody's paying too much.
Too
Yeah,
much.
everybody feels like they're paying more than they ever have before. When the reality is that tax rates currently, as much as we hate to admit it, are about as low as we've ever seen. And they could maybe, here in the next few years, arguably go a little bit lower, but that's going to be temporary. I really think the long-term trend is going to be higher when you look at how much money we need to support the baby boomers as they transition into using our entitlement programs of Social Security, Medicare, and sometimes Medicaid.
I was reading somewhere by about 2030, I think, if we don't change the way we're spending, about 90%, right? 90% of our nation's operating expenses is going to go towards Social Security and Medicare.
Yeah, Social Security and Medicare, correct. And so that's going to leave roughly about 10 cents left over to pay for everything else, unless, of course, tax rates go higher. So I think that's probably what we'll see in the future. And that's why I really think that's the number one threat.
Well, if you all have any more questions about taxes, how to protect yourself, and really transition to a tax-free strategy, feel free to give us a call or check us out on the website.
So there's many things you need to be aware of, but what we've done is we've broken it down into really the 6 most important things, the 6 top things you need to be aware of and have in place before you go into retirement. So in the office all the time, we're talking to clients about all the things that you need to be aware of and to be thinking about if you're getting ready to retire, or especially if you're already in retirement. So there's many things you need to be aware of, but what we've done is we've broken it down into really the 6 most important things, the 6 top things you need to be aware of and have in place before you go into retirement. Number 1 is you need to assess your income needs. So this is going to be things like your Social Security. This could be pensions from employment. This could be a bond portfolio if you're drawing some type of interest off of that. Annuities, basically anything that's producing some guaranteed income that's not going to fluctuate when the market does. Number 2 is you need to know your budget. So this is going to be things like how much does it cost to live like your standard of living without reducing it at all. This could be things that could increase in retirement. So you may golf more, you may vacation more. So you need to budget for that type of thing. So this could be, we're going to say travel, we're going to say golf, and anything else that you're going to want to do in retirement. You need to understand that number and build a plan, and then you need to follow that plan and understand, is there going to be any shortfalls? Are there any areas that we could potentially reduce expenses, or can we increase income? So that would be number 2. Number 3 is you need to assess your current financial situation. Now, what this would mean is you really need to look with a financial advisor and, number 1, see how much risk is in your portfolio. Find out how much in fees that you're paying each year in your portfolio. Do you have stocks, bonds, mutual funds, things that may have worked for you in your accumulation phase that now, since you're transitioning over into retirement, they're probably not going to be the right tools. So understand your current situation and where you may need to make some adjustments and changes. Number 4 is going to be what can go wrong. Of course, nothing can go wrong, right? What we need to do is, as an advisor, is plan for any potential problems that we could have in retirement. Now, this could be market loss. This could be any type of health issue. If you needed to go into the hospital for an extended period of time, this could be a long-term care scenario. What if What if something happened and you actually had to go into a long-term care facility? Another thing that people don't plan for a lot of times is inflation. So inflation runs historically at about 3.5%. So that's something you need to plan for, because over time, 3.5% per year can add up. Finding an advisor. I think this is one of the most important things up here on the list. And finding the right advisor, there's so many people out there that are so-called experts at financial advice, but unfortunately, not all advisors are created equal. So some advisors will help you in getting yourself to retirement, taking a lot of risk along the way, using things like stocks and mutual funds, things that are going to fluctuate quite a bit in value. And with retirement planning, what we want to do is, well, now we've taken all that risk all of those years, and you've gotten yourself here. Now it's about protecting and preserving everything you have in your portfolio so that you don't experience any potential losses, which would obviously affect your standard of living. So finding an advisor, you're going to want to find someone that is a fiduciary. What that means is they have to only recommend products or tools that are going to help you get to your goals. So they're only allowed to recommend what is in the client's best interest. And then down here, build a plan. This is so important. So you need to understand all of this to build your financial plan. Once you have built that plan, you need to follow it. So once you've built that plan, it's so important that you follow that plan. And I realize I made an A there. Sorry about that. So we need to know up front, are there going to be any shortfalls? Do we need to decrease what we're spending each month to maintain our standard of living? Can we travel more? Should we travel less? Can we afford to help the grandkids in college this year? So it's so important to follow that plan once you have it in place so that you can have a successful and happy retirement without ever having to deal with stresses. If you have any questions about how to get your portfolio set up to make sure you're following these 6 important rules, feel free to call our office and/or visit our website.
Unfortunately, sometimes individuals, as we get a little older, even though we want to continue to work, not always able to find another job.
Right.
Certainly not one that maybe pays the high income or salary like we were used to. So.
This week in the office, we had an individual come by that was actually forced into retirement earlier than they had thought. She was kind of in panic mode and wondered what to do next. So Matt, can you help explain what we were able to do there?
Yeah, this unfortunately is a scenario that happens a little more often than I think people would like, where by no fault of their own, for whatever reason, whether it be a company maybe closes its doors or there's at least a downsizing or something of that nature. Unfortunately, sometimes individuals, as we get a little older, even though we want to continue to work, not always able to find another job.
Right.
Certainly not one that maybe pays the high income or salary like we were used to. So, like you mentioned, a little bit of a panic. This wasn't planned.
Right.
Had planned on working at least another 2 or 3 years, I believe, but now retirement was upon them. So, one of the first things I always recommend when this happens is you certainly want to take whatever retirement plan you have. A lot of times it's a 401k. You want to roll that over to an IRA. You do that for several reasons, like we've talked about here on the show in the past. You need to get more control over your money, possibly reduce fees. But probably the big issue is this, especially if it's a company that looks like it's falling on maybe harder times, and that's why they're downsizing. If your previous employer, if you leave your money in the 401k and then that company files for bankruptcy, unfortunately, those assets that you had in your 401k, they're frozen until the bankruptcy is done. So if you need to take withdrawals to maintain your standard of living, you can't. Now, you're not going to lose the money. Eventually, you're going to get it. But you cannot do anything with it. So if you want to change the way it's invested because the stock market's reacting a certain way, you can't do that either. So first thing you want to do is roll over the assets. Once the bankruptcy is over, though, I mean, then you can do whatever you want. But you just don't want to have to wait because that can sometimes take years. So first thing to do, roll money into an IRA, and then from there, start to develop an income plan.
Okay. You could potentially be locked into whatever losses you may have had happen.
Yeah, and especially this is very critical for anybody that has any money invested in the company stock.
Right.
Again, for whatever reason you lost your position there, you may not want to own that company stock anymore. You might be a little upset. But there might be another financial reason as to why they're doing the downsizing or maybe closing a particular plant or division or something like that. So you just don't want to risk it. So roll it to an IRA, then you've got to start to develop a retirement plan. I think the first thing, though, that you really have to try and do is to not do what they were doing when they came to the office, and that is panic. Right. It's understandable. It was unexpected, but typically you want to get the money rolled out of the 401k as quickly as you can. But after that, usually you have plenty of time to then regroup, say, okay, here's what's happened. Maybe you need to take some sort of a withdrawal to buy yourself some extra time as you then decide, okay, now that I'm at this phase of my life, what do I want to do next? And how do we start planning, making sure that this money is going to last forever? So what ends up happening is once we've got the rollover process, then it's kind of a typical set of questions and scenarios that we then have to start to work through and try and determine on what happens next now that this unforeseen event occurred.
Right. Thanks, Matt. If you would like more information or if you have any questions, please feel free to call our office and/or visit our website.
And what I want to do today is I want to just simply give you guys 3 steps, right? 3 critical things that you can follow on how you can invest more for the long term, and a couple of things that you can do in your portfolio to put yourself in a good position. Welcome to this week's segment of Strategic Wealth University. I'm Jordan Schwartz, and today I want to talk with you guys about long-term investing and really what that means for us as a firm. I think oftentimes what happens is we watch a lot of media, we see the stock market, and we see all these high peaks and deep valleys in the market. And what I want to do today is I want to just simply give you guys 3 steps, right? 3 critical things that you can follow on how you can invest more for the long term, and a couple of things that you can do in your portfolio to put yourself in a good position. Now, the first step that we have is we want to make sure that our risk matches our reward. Vast majority of the time, I'd say probably maybe 7 to 8 to maybe 9 times out of 10, whenever folks come into the office, the goals in their portfolio does not match their portfolio. There's a disconnect. A lot of times what we'll find is that there is way more risk in their portfolio than what their goals are. There's that major disconnect. So what we want to do first and foremost is we want to make sure that our goals and our objectives align with our portfolio. Because as the market does have its periods and its bouts of volatility, its highs and lows, I think a lot of people oftentimes are, startled sometimes whenever the market starts to go through these big drops because they felt that their portfolio had less risk in it, and in actuality, it had a lot more. So again, step number 1 is to make sure that we have a really good job at making sure that our risk matches our reward. Now, step number 2 is to invest over the long term, right? We want to invest over the long term. Again, with these periods of volatility that we'll find, a lot of people pull their money out of the market when it's at all-time highs, or pull their money out of the market when it's at all-time lows, and then what they'll do is they'll actually buy back into the market at all-time highs. There's this interesting paradigm or this interesting kind of concept that happens where when we first start learning to invest, probably the first thing, and this is for me, the first thing I learned was you want to buy low and you want to sell high, right? We want to buy low and sell high. Now, what we oftentimes find and what the numbers are showing is that the vast majority of individuals out there, they're actually buying at all-time highs and they're selling at all-time lows, right? They're buying at all-time highs and they're selling at all-time lows. That puts the vast majority of Americans in a position where they're probably not going to have the kind of growth that they want because they're investing over the short term. They're allowing the ups and downs of the market to get the best of them, and that's putting them in a not so good position. So the second thing we want to do is that we want to invest over the long term. The third thing we want to do, right, the third critical step that we want is we want to have a dynamic and well-balanced portfolio. Now, oftentimes what we'll find whenever individuals come into the office, they have way too much risk in their portfolio. And the reason for that is that it's pretty much always stocks. Maybe a few bonds, but the vast majority of the portfolios of what we find is all stocks and a little bit of bonds. So what we want to do is we want to create that proper diversification. And a way to do that is what's called asset allocation. This is a really interesting topic. asset allocation. And that's maybe a little bit of a technical word of saying something really simple. And that just means, where's your money? Right? So what we find with a lot of portfolios is folks have just stocks and bonds. Now, what we want to do with our portfolios is we want to have stocks and we want to have bonds. But we also want to have things like commodities, maybe oil or corn or different things like that. We want to have precious metals like gold or silver. We want to have real estate. We want to have treasuries. We want to have all these different asset classes and asset groups that move in different directions. So in good rising markets and in falling markets, in high inflation markets and in low inflation markets, we can stay safe and protected, but we can also find really good growth. So that would be the third thing, of course, having a dynamic and well-balanced portfolio. So as a recap, number one is to make sure that the risk matches the reward, right? We need to make sure that the risk matches the reward. Now, step number two, or the second thing that you can do, is that you want to make sure that you're investing over the long term, right? We're investing over the long term. And the third thing we want to do again is we want to have a dynamic and well-balanced portfolio. I was meeting with a really awesome woman the other day. Her name was Sarah. And she was talking to me and she said, Jordan, I've already had the opportunity to watch the show. I've been to an educational workshop that you guys host around town, but I want to find something more. I want to learn a little bit more about how I can put myself in a better position, how I can maybe have a much better chance of succeeding in retirement. And I told her, Sarah, a great resource that oftentimes is misunderstood or misunderused is our website. Our website has a ton of resources. It gives you the ability to, if you're at church or you're at some sort of thing on Sunday mornings, you can go on the website and watch that. We've got a ton of great articles you can read through. A couple of things actually that were published through Kiplinger that we've done over the past couple of years. And what we want to do is we want to give you some more tools and some more strategies on how you can succeed beyond just watching the show or coming to an event. So I said, Sarah, check out the website. It's awesome. If you haven't been to our website, it's at www.swdgroup.com. Make sure that you check it out. It's got a ton of great resources. And as always, if you have any questions or you need anything at all, please give us a call or check us out on the website. Thank you.